Introducing the book, Mastering the Psychology of Money, by Thakuri Studio. In this insightful book, you'll discover how your mindset, emotions, and habits influence your financial decisions, and learn practical strategies to transform your relationship with money. Covering topics such as the emotional impact of wealth, behavioral finance biases, and how to achieve financial independence, this book empowers you to take control of your financial future. Published by Thakuri Studio, this comprehensive guide provides key lessons on how to build wealth, manage risks, and find true financial freedom, all while maintaining a balanced, fulfilling life. Whether you're looking to make smarter financial decisions or seeking deeper understanding of how money affects your life, Mastering the Psychology of Money is the perfect tool to help you on your journey. Grab your copy now and start transforming your financial mindset. Introduction: The Psychology of Money. Purpose: why understanding the psychology behind money is crucial for financial success. Money, at its core, is simply a tool, a medium of exchange that allows us to trade value. But in reality, money is far more complex than that. Our relationship with money is deeply intertwined with our emotions, beliefs, and behaviors. Understanding the psychology behind money is crucial because it directly influences every financial decision we make, from spending and saving to investing and planning for the future. Without awareness of the psychological forces at play, we are more likely to fall into common financial traps, such as overspending, impulsive investing, or avoiding necessary financial planning out of fear or stress. A lack of understanding can lead to financial instability, stress, and ultimately prevent us from achieving financial freedom. Mastering the Psychology of Money, on the other hand, empowers us to make better financial decisions. It helps us develop a mindset that aligns with our long-term goals, allowing us to manage emotions like fear and greed, which are often the biggest obstacles to financial success. Whether it's learning how to embrace patience when investing or overcoming the fear of loss, understanding these psychological dynamics is the key to not just making money, but keeping and growing it. Overview: the relationship between mindset and wealth accumulation. Wealth accumulation isn't simply about earning a high income or getting lucky with investments. It's about developing the right mindset, a psychological framework that drives consistent, smart financial behaviors over time. Our mindset shapes our habits, and habits ultimately determine our financial outcomes. There are two core mindsets that dominate how people think about money: the scarcity mindset and the abundance mindset. Scarcity mindset. People with a scarcity mindset believe there's never enough money. This can lead to fear-based financial decisions, such as hoarding money, avoiding risks, or making desperate financial moves that are short-term focused. Abundance mindset. On the other hand, people with an abundance mindset believe that money is a tool that can be grown and multiplied. They understand that wealth accumulation is not a zero-sum game and are more likely to take calculated risks, invest in their growth, and think long-term. The relationship between mindset and wealth accumulation is powerful. Those with a growth-oriented, abundance-focused mindset tend to create more wealth because they view challenges as opportunities, practice delayed gratification, and are willing to take risks when necessary. They understand that building wealth takes time and discipline, while a scarcity mindset can trap people in a cycle of stress, fear, and short-term thinking, which limits their financial potential. Throughout this book, we'll dive deeper into how your thoughts and emotions influence your financial life and how you can rewire your mindset to align with long-term wealth-building principles. Chapter 1: Money and Human Behavior. The emotional connection to money. Money is often viewed as a purely rational and logical entity: numbers on a page, income, expenses, and investments. But beneath these calculations lie deep emotional currents that influence how we handle money on a daily basis. Emotions like fear, greed, and anxiety play a significant role in shaping financial decisions, often leading us away from optimal choices. Fear. Fear is perhaps the most pervasive emotion when it comes to money. Whether it's the fear of not having enough, the fear of losing what we have, or the fear of making the wrong financial decision, fear can paralyze us. This emotion often leads to overly conservative financial behavior, such as hoarding cash, avoiding investments, or sticking to low-risk, low-return strategies. While caution is necessary, excessive fear can prevent us from taking calculated risks that are essential for long-term wealth accumulation. Greed. Greed operates on the opposite end of the spectrum, driving people to pursue financial gains without considering the risks or long-term consequences. Greed can cause people to make impulsive decisions, like chasing quick profits in speculative investments, ignoring the fundamentals of the market, or over-leveraging their assets. While ambition and a desire for wealth are natural, unchecked greed often leads to poor decision-making and financial ruin. Anxiety. Money anxiety manifests in various ways, from constantly worrying about bills to stressing over financial plans that are years away. This can create a cycle of worry, where the fear of losing money leads to obsessive behavior, such as constantly checking account balances, or avoidance, where people fail to confront financial issues altogether. The key to managing these emotions is awareness. By recognizing how fear, greed, and anxiety affect your financial behavior, you can begin to make more rational, thoughtful decisions. The goal is not to eliminate these emotions but to learn how to manage them effectively. Financial success comes when we strike a balance, avoiding reckless greed but also confronting fear and anxiety with informed, measured action. The scarcity and abundance mindsets. One of the most powerful forces shaping our financial decisions is our mindset, specifically, whether we operate from a place of scarcity or abundance. These two mindsets form the foundation of how we view money and play a significant role in determining our financial behaviors and outcomes. Scarcity mindset. People with a scarcity mindset believe that resources are limited. This belief is often rooted in fear and leads to a worldview where money feels like a finite resource that must be clung to and protected at all costs. Individuals with a scarcity mindset often focus on survival rather than growth. This can result in behaviors like extreme frugality, avoiding investments due to perceived risks, and a general reluctance to pursue opportunities that could lead to financial growth. The irony is that this mindset can trap individuals in a cycle of scarcity. By avoiding risk and focusing on preservation, they miss out on the potential to grow their wealth. Abundance mindset. In contrast, the abundance mindset operates from the belief that there is plenty to go around, and that wealth can be created, not just hoarded. People with an abundance mindset are more likely to take calculated risks, invest in themselves, and seize opportunities for financial growth. They understand that wealth is not a zero-sum game. Just because someone else has more doesn't mean you will have less. This mindset fosters an attitude of generosity and collaboration, encouraging behaviors like sharing knowledge, building networks, and investing in long-term growth. The scarcity mindset tends to breed financial stress and anxiety, while the abundance mindset encourages optimism, confidence, and a focus on long-term success. Shifting from scarcity to abundance is not about ignoring financial realities, it's about reframing challenges as opportunities and recognizing that wealth building is a process of growth, not merely preservation. This shift in mindset can transform your financial future. Instead of reacting to every market fluctuation with fear, or seeing every expense as a threat, you begin to view money as a tool that can be leveraged to build something greater. This allows you to take calculated risks, invest in new opportunities, and approach financial decisions with a sense of optimism and possibility. Chapter 2. The History of Money and Human Nature. From barter to Bitcoin, a brief history of money and its psychological impact. The concept of money has evolved dramatically over millennia, and with each shift, human psychology has adapted in profound ways. Understanding the historical journey of money from the earliest forms of barter to the rise of digital currencies like Bitcoin reveals how our relationship with wealth has been shaped by societal, economic, and psychological forces. Barter systems. In ancient times, people relied on barter to exchange goods and services. This system was limited by the need for a double coincidence of wants. Both parties had to want what the other had to offer. While efficient for small, local transactions, barter was psychologically constrained by its inefficiency, fostering a mindset of immediate utility and direct exchange. The focus was survival, gathering resources directly related to one's immediate needs. The invention of money. The introduction of commodity money, such as shells, livestock, and precious metals, marked a major psychological shift. By assigning value to a physical object, societies moved from direct exchange to a more abstract form of trade. Money became a symbol of value, trust, and social cooperation. People now had a way to store wealth, trade across distances, and save for the future, opening the door to long-term planning, investment, and the accumulation of wealth. Psychologically, this shift encouraged forward thinking and fostered the human ability to delay gratification. Coins and paper currency. As civilizations grew, metal coins and later paper currency replaced commodity money. This allowed for standardized units of value, making trade more efficient and expanding economic systems. With these developments came the growth of banking and lending, introducing new psychological concepts like interest, credit, and debt. These ideas reshaped how people perceived time, risk, and reward, linking current behavior to future financial outcomes. The rise of digital money. In the 20th century, money became even more abstract with the rise of credit cards and electronic banking. This created a detachment between the physical act of spending and the psychological feeling of loss. As digital transactions grew, people found it easier to spend without experiencing the immediate emotional consequence of parting with physical cash. This shift has contributed to increased consumer debt and impulsive financial behaviors, as the act of spending became less emotionally tangible. Cryptocurrency and Bitcoin. Today, we are witnessing the next evolution of money with the rise of cryptocurrencies like Bitcoin. These digital currencies, decentralized and independent of government control, represent a fundamental change in how we think about and use money. The psychological impact of cryptocurrency is profound. It challenges long-held beliefs about trust in centralized institutions like banks and governments, fostering a mindset of individual financial sovereignty. For many, cryptocurrencies symbolize freedom from traditional financial systems, but they also come with high levels of volatility and risk, triggering both excitement and fear in the minds of investors. Through this historical lens, it becomes clear that the evolution of money is not just an economic phenomenon but a psychological one. As money became more abstract, our relationship with it grew more complex. Today, the psychological impacts of digital transactions, credit, and cryptocurrencies reflect a tension between immediate gratification and long-term security, between trust in systems and control over our own financial destiny. The survival instinct and wealth, how evolution plays a role in our financial behavior. Human beings have been shaped by millions of years of evolution, and much of our financial behavior can be traced back to instincts that helped our ancestors survive. These deep-rooted evolutionary instincts often influence how we think about money, wealth, and risk in ways that may no longer serve us in the modern world. The fight for resources. In prehistoric times, survival was dependent on gathering and hoarding resources like food, shelter, and tools. These resources were often scarce, leading to a mindset of competition and fear of loss. This scarcity mindset still exists today, deeply influencing how we handle money. Many people instinctively feel that wealth is finite, leading to behaviors like hoarding savings, avoiding investment risks, or focusing on short-term gains rather than long-term growth. This survival instinct often makes it difficult for individuals to embrace the uncertainty and calculated risks needed to build wealth. Loss aversion. Our brains are wired to avoid loss, a trait that was crucial for our ancestors' survival. This loss aversion means that the pain of losing something is psychologically more impactful than the pleasure of gaining something of equal value. In financial terms, this manifests as a fear of losing money, leading to overly conservative financial behavior. For example, many people avoid investing in stocks or real estate because the potential for loss feels too risky, even if the long-term rewards could be substantial. This evolutionary trait often prevents people from making the bold decisions necessary to accumulate wealth over time. Immediate gratification. In the early days of human evolution, there was little incentive to delay gratification. Survival often depended on taking immediate action, whether it was eating food when it was available or using resources to build shelter. This instinct for immediate gratification is still prevalent today and can make it difficult for people to save or invest for the future. Many financial mistakes, such as overspending or accumulating debt, stem from the desire for immediate rewards rather than long-term planning. Tribal mentality. Humans evolved in small, tight-knit groups where cooperation was essential for survival. This tribal mentality still influences how we think about money, particularly when it comes to social comparison. We instinctively look to those around us to gauge our financial success, leading to behaviors like keeping up with the Joneses or chasing status symbols. This evolutionary drive for social standing often leads people to make poor financial decisions, such as purchasing expensive cars or homes they can't afford, just to signal their wealth to others. Risk and reward. Our ancestors had to weigh the risks and rewards of every decision they made, whether it was hunting dangerous animals or migrating to new territories. Today, this instinct plays a significant role in how we approach financial decisions. While some people are naturally more risk-averse, others are more inclined to take risks, often depending on their personality and upbringing. Understanding this evolutionary backdrop helps explain why different people have vastly different attitudes toward risk and reward, and why it's so important to develop a balanced approach in financial decision-making. In modern society, many of these survival instincts can work against us, especially when it comes to building wealth in a complex financial environment. Recognizing these ingrained behaviors is the first step toward overcoming them and developing a more rational, forward-thinking approach to money. This chapter illustrates how both the history of money and our evolutionary biology influence the way we think about and interact with wealth. Chapter 3: Wealth, Status, and Happiness. The myth of more. Why more money doesn't always mean more happiness. One of the most persistent myths in society is the idea that more money automatically leads to greater happiness. While money can certainly provide comfort, security, and opportunities, research shows that after a certain point, the relationship between wealth and happiness begins to break down. The diminishing returns of wealth. Studies in behavioral economics have shown that once basic needs are met, such as food, shelter, and health, additional wealth has a diminishing effect on overall happiness. This concept is known as the law of diminishing marginal utility. After achieving a certain level of financial security, each additional dollar contributes less and less to a person's overall well-being. In fact, beyond a certain threshold, more money can actually lead to more stress, anxiety, and dissatisfaction, as the focus shifts from contentment to the endless pursuit of more. Hedonic adaptation. One of the key reasons that more money doesn't necessarily equate to more happiness is hedonic adaptation. This is the psychological phenomenon where people quickly adjust to improvements in their circumstances and revert to a baseline level of happiness. For example, receiving a pay raise or buying a new car might bring a temporary boost in happiness, but over time, the excitement fades, and you return to your previous emotional state. This means that no matter how much wealth you accumulate, your happiness will eventually adapt, making the pursuit of endless financial gain an unsatisfying goal in the long run. More money, more problems. The pursuit of wealth can also introduce new forms of stress and dissatisfaction. As people earn more, their expenses often increase as well, a concept known as lifestyle inflation. A bigger house, nicer car, or more luxurious vacations might seem like markers of success, but they come with additional responsibilities and pressures, leading to what many describe as golden handcuffs, a life that feels increasingly restricted despite outward success. The weight of maintaining an elevated lifestyle can detract from the sense of freedom and well-being that wealth is supposed to bring. Purpose and meaning over wealth. True happiness often comes not from the amount of money a person has but from the sense of purpose and meaning in their life. Studies show that people who focus on meaningful relationships, personal growth, and contributions to their community tend to experience higher levels of happiness than those who focus solely on financial success. While money can facilitate certain experiences, it cannot replace the deep fulfillment that comes from pursuing meaningful goals and connections. The myth that more is better traps many people in a perpetual cycle of dissatisfaction. Understanding that wealth is only a tool, rather than an end in itself, helps to break free from this mindset. Focusing on what truly brings joy, whether that's time with loved ones, personal development, or pursuing a passion, leads to greater, more lasting happiness than chasing after more material wealth. Status anxiety. How social comparison affects our financial decisions. Wealth is not just about what you have, it's also about how it compares to what others have. This tendency to measure our success against others is a deeply ingrained aspect of human nature, and it plays a significant role in how we perceive our own financial well-being. This is often referred to as status anxiety, and it can have a profound impact on our financial decisions. The social hierarchy in money. Humans have always lived in social hierarchies, where status played a critical role in survival. In modern society, money has become one of the most visible indicators of status, and we often use it as a way to signal our success and social standing. Whether consciously or subconsciously, people tend to compare their financial situation to those around them: friends, family, neighbors, and colleagues. This need for comparison is often amplified by social media, where curated images of success and wealth are constantly on display. Keeping up with the Joneses. This phenomenon, commonly known as keeping up with the Joneses, leads many people to make financial decisions based on what others are doing, rather than what is best for their personal situation. Seeing someone else purchase a new car, go on an extravagant vacation, or move into a bigger house can trigger feelings of inadequacy or envy, leading to unnecessary spending or taking on debt to match or exceed the perceived status of others. This drive to keep up often leads to financial strain, as people prioritize outward appearances over financial stability. The psychological trap of social comparison. The problem with status anxiety is that it creates a never-ending cycle of dissatisfaction. There will always be someone who has more money, a bigger house, a nicer car, or a higher-paying job. This constant comparison can lead to feelings of inadequacy, even if someone is financially secure by most standards. Relative wealth, not absolute wealth, becomes the primary focus, which can erode happiness and contentment. The role of materialism. Status anxiety is closely tied to materialism, the belief that acquiring more possessions leads to happiness. However, research consistently shows that materialistic values are associated with lower levels of well-being and life satisfaction. People who place a high value on material wealth often experience higher levels of anxiety, depression, and dissatisfaction because they are constantly measuring their worth based on external factors, rather than internal fulfillment. Overcoming status anxiety. Overcoming status anxiety requires shifting focus from external comparisons to internal values. One effective strategy is gratitude, focusing on what you already have, rather than what you lack. Studies have shown that practicing gratitude can significantly increase feelings of contentment and reduce the urge to compare yourself to others. Another key is redefining success in terms of personal fulfillment, relationships, and life experiences, rather than material possessions or financial status. In addition, cultivating financial independence where your happiness and well-being are not tied to the opinions or behaviors of others can lead to greater peace of mind. When you stop comparing yourself to others, you gain the freedom to make financial decisions based on your own values, needs, and goals. This chapter explores how wealth and status impact happiness and how social comparison drives many financial decisions. Chapter 4. Risk and Reward in Decision-Making. Understanding risk perception. How we irrationally assess financial risks. Risk is an inevitable part of any financial decision, whether it's investing in the stock market, starting a business, or even choosing to save rather than spend. However, humans are not naturally good at assessing risk. Our brains evolved to protect us from immediate dangers like predators or natural hazards, not the abstract and often complex risks associated with modern financial decisions. As a result, we tend to make irrational choices when it comes to risk and reward. Fear-based risk assessment. One common issue is that people tend to overestimate risks that evoke fear and underestimate those that feel familiar. This is partly due to the availability heuristic, a cognitive bias where we assess the likelihood of an event based on how easily we can recall similar events. For example, after hearing about a stock market crash or a high-profile investment failure, people often overestimate the risk of investing and become overly cautious. On the other hand, familiar risks such as holding cash in a savings account that loses value to inflation are often underestimated because they don't trigger the same level of fear, even though they can significantly erode wealth over time. Optimism bias. Another distortion in risk perception is the optimism bias, where people tend to believe that negative events are less likely to happen to them than to others. This can lead to underestimating personal risks, such as taking on too much debt or engaging in speculative investments without fully understanding the potential downsides. Optimism bias is particularly dangerous in financial markets, where people can become overconfident, chasing high returns without properly accounting for the potential for loss. Certainty bias and overweighting low probabilities. We also have a strong desire for certainty, which can lead to irrational behavior. For instance, people often choose a certain but lower reward over a higher but uncertain reward, even when the odds are in their favor. Conversely, we sometimes place too much emphasis on extremely low probability events, like winning the lottery or making a fortune on a risky investment. This leads to behaviors such as buying lottery tickets or making speculative investments in the hope of a big payoff, even though the probability of success is minuscule. Short-term versus long-term thinking. Our natural tendency to focus on the present, known as present bias, makes it difficult for us to accurately assess long-term risks and rewards. People often make decisions that offer short-term comfort but create long-term financial difficulties. For example, someone might avoid investing because of the risk of short-term market volatility, even though long-term market growth is likely to yield substantial gains. Similarly, people may opt for immediate consumption, like spending on luxury goods, rather than saving or investing for long-term security. To combat these cognitive distortions, it's important to cultivate an understanding of rational risk-taking. This means using data, probabilities, and a long-term perspective to evaluate financial risks and rewards, rather than relying on gut instincts or emotional reactions. Risk is an essential part of wealth building, but the key is to manage it wisely. The role of loss aversion. Why we fear losing money more than we enjoy gaining it. One of the most influential psychological concepts in decision-making is loss aversion, a theory developed by psychologists Daniel Kahneman and Amos Tversky. Loss aversion suggests that people experience losses more intensely than gains of the same magnitude. In other words, losing $100 feels much worse than gaining $100 feels good. This disproportionate emotional response to losses plays a significant role in how we make financial decisions. The power of loss. Loss aversion is rooted in evolution, where avoiding losses like food, shelter, or physical safety was critical for survival. This instinct is still strong today, especially in financial decisions. For example, people are often willing to take significant risks to avoid a loss but are much more conservative when it comes to pursuing potential gains. This can lead to irrational behaviors, such as holding on to losing investments in the hope of recovering losses, rather than cutting losses early, or avoiding beneficial risks, like investing in the stock market, due to fear of losing money. Impact on investing behavior. Loss aversion leads many investors to make poor decisions, such as panic selling when the market drops. When stock prices fall, the emotional pain of seeing their portfolio lose value drives people to sell at a loss, even if the downturn is temporary. This behavior locks in losses and often prevents investors from benefiting from market recoveries. Conversely, the fear of loss can also prevent people from entering the market at all, causing them to miss out on the long-term benefits of compound growth. Overweighting potential losses. Another consequence of loss aversion is that people tend to overweight the probability of losses and underweight the potential for gains. For example, when evaluating a potential investment, people often focus more on the possibility of losing money than on the probability of earning a higher return. This skewed risk-reward evaluation leads to overly conservative financial behavior, such as keeping too much money in low-yield savings accounts or avoiding higher return investments like stocks or real estate. Sunk cost fallacy. Loss aversion also contributes to the sunk cost fallacy, where people continue to invest time, money, or resources into a failing venture because they feel they've already invested too much to quit. In financial terms, this could mean holding onto a stock that is losing value because selling it would mean admitting the loss. However, rational decision-making requires that we evaluate future potential, not past investments. How to overcome loss aversion. To mitigate the effects of loss aversion, it's essential to focus on long-term outcomes rather than short-term fluctuations. A diversified investment strategy that balances risk and reward can help reduce the emotional impact of losses. Additionally, creating an investment plan based on specific goals and time horizons can prevent emotional reactions to market volatility. Understanding that temporary losses are a natural part of investing helps to alleviate the fear and allows you to stay committed to long-term growth. Loss aversion is a powerful force in financial decision-making, but it can be managed with education, self-awareness, and a focus on long-term goals. Recognizing when loss aversion is influencing your decisions is the first step toward making more rational, data-driven financial choices. This chapter examines how our perception of risk and fear of loss distort financial decision-making. Chapter 5. The Role of Time and Patience in Wealth Building. The Power of Compounding. Why patience is the most underrated tool in wealth building. One of the most powerful yet often overlooked tools in wealth building is time. The secret lies in the power of compounding, the process where your earnings generate more earnings over time, creating exponential growth. This concept is fundamental to understanding how wealth is truly built over the long term, and it requires one crucial trait: patience. Understanding compounding. Compounding occurs when the returns on your investments, whether in the form of interest, dividends, or capital gains, are reinvested to generate additional earnings. Over time, this creates a snowball effect, where even small initial investments can grow significantly. Albert Einstein reportedly called compounding the eighth wonder of the world, because of its potential to transform modest amounts of money into substantial wealth, provided you give it enough time to work. Example of compounding. Consider a $1,000 investment earning an average annual return of 7%. In 1 year, the investment would grow by $70, 7% of $1,000, bringing the total to $1,070. In the second year, you're not just earning 7% on your initial $1,000, but on the $1,070 total. By the end of the second year, your investment grows to $1,144.90, and the process continues, with the returns on your returns creating exponential growth. The time factor. The key ingredient in compounding is time. The earlier you start investing, the more time your money has to grow. Small, consistent investments made over decades can lead to far greater wealth than larger, sporadic investments made over shorter periods. For example, if you invest $200 per month starting at age 25 with a 7% annual return, by age 65, you could have close to $500,000. If you wait until age 35 to start the same $200 per month investment, you'll end up with roughly half that amount by age 65. Patience and delayed gratification. Patience is essential for reaping the full benefits of compounding. It can be tempting to pull money out of investments to spend on short-term wants, but this interrupts the compounding process. The real magic of compounding happens over decades, not years. This requires a mindset shift from instant gratification to delayed gratification, the ability to wait for a larger reward in the future, rather than chasing smaller rewards in the present. Resisting the urge to time the market. Many people believe they can time the market by buying low and selling high. However, research consistently shows that time in the market, staying invested over the long term, beats attempts to time the market. Even missing just a few of the best trading days in the market over a period of several decades can drastically reduce your returns. Patience and consistency are far more effective than trying to outguess the market's movements. The power of small, consistent actions. One of the misconceptions about wealth building is that it requires large sums of money to get started. In reality, small, consistent actions such as regularly contributing to a retirement account or reinvesting dividends can lead to massive growth over time. The combination of consistency and patience is far more important than starting with a large sum of money. This principle can be applied to all areas of personal finance, including paying down debt or saving for a large purchase. In summary, compounding is the cornerstone of wealth building, but it only works if you allow time and patience to do their job. The earlier you start, the less effort is required to achieve significant financial growth, and the more time you have to reap the rewards. Short-term versus long-term thinking. How to shift your mindset from immediate gratification to future growth. In the modern world, we are constantly bombarded with opportunities for immediate gratification. From instant access to entertainment to one-click online shopping, our society promotes the idea that you can and should have what you want right now. However, this short-term thinking can be detrimental to wealth building, which requires a long-term perspective. The psychology of short-term thinking. Human beings are wired to focus on the present. In evolutionary terms, immediate needs like food, safety, and shelter were crucial for survival. This present bias can lead to impulsive financial decisions, such as overspending on luxury items, taking on unnecessary debt, or prioritizing short-term pleasure over long-term security. Many people fall into the trap of buy now, pay later, which results in accumulating debt and derailing long-term financial goals. Shifting to a long-term mindset, wealth building requires a shift in mindset from instant gratification to future growth. This means prioritizing long-term goals such as saving for retirement, investing in assets, or building an emergency fund over immediate desires. One key to making this shift is to focus on the compounding rewards of long-term thinking, as mentioned earlier. By visualizing the future benefits of delaying gratification, you can motivate yourself to make smarter financial choices today. Setting long-term financial goals. One way to encourage long-term thinking is to set clear, specific financial goals. These could include saving for a home, paying off debt, or achieving financial independence. When you have a clear vision of your future goals, it becomes easier to make sacrifices in the present. For example, setting a goal of saving $1 million for retirement by a certain age can help you stay disciplined with your spending and investments. Automating financial decisions. One effective strategy for maintaining a long-term mindset is to automate financial decisions. By setting up automatic transfers to savings accounts or investment funds, you remove the temptation to spend the money elsewhere. Automation ensures that your long-term goals are prioritized before short-term desires, and it can reduce the mental effort required to make good financial choices consistently. The cost of impatience. Impatience can be incredibly costly when it comes to wealth building. For example, withdrawing money from an investment account early can result in penalties, lost returns, and missed compounding growth. Similarly, making impulsive purchases on credit can lead to high-interest debt that erodes your ability to save and invest for the future. Recognizing the long-term cost of impatience can help reinforce the benefits of staying committed to your financial plan. Celebrating small wins. While long-term thinking is essential, it's also important to celebrate small financial victories along the way. By acknowledging progress toward your goals such as reaching a savings milestone or paying off a debt, you reinforce the habit of future-oriented thinking without feeling deprived in the present. These small wins can help maintain motivation and keep you on track for larger, long-term achievements. Building a resilient mindset. Patience also involves the ability to weather short-term setbacks. The financial markets, for example, are prone to volatility, and there will inevitably be periods of loss or stagnation. A resilient, long-term mindset allows you to stay the course, knowing that temporary setbacks are part of the journey to wealth building. By keeping your focus on the bigger picture, you can avoid making emotional, short-term decisions that could undermine your financial success. In summary, shifting from a short-term to a long-term mindset is one of the most important steps in wealth building. By embracing the power of compounding, setting clear goals, and automating financial decisions, you can overcome the temptation for immediate gratification and achieve lasting financial success. This chapter highlights the importance of time and patience in financial growth. Chapter 6: Financial Independence and Freedom. What does financial freedom really mean? Understanding true freedom beyond just having money. Financial freedom is often portrayed as a state where you have enough money to never worry about expenses again. However, true financial freedom goes beyond simply accumulating wealth. It's about achieving control over your time, decisions, and life direction, allowing you to pursue meaningful experiences without the constraints of financial stress. Beyond wealth, control over choices. Financial freedom is not just the ability to buy things, it's the ability to choose how you live your life. This means having the freedom of time, the power to decide when and how to work, travel, or pursue passions. Many people misunderstand financial freedom as a never-ending pursuit of money, but in reality, it's about removing money as a primary constraint in decision-making. True financial freedom is having the ability to align your life with your values, goals, and aspirations, rather than being controlled by the need to constantly earn more. The stress of living paycheck to paycheck. For those who live paycheck to paycheck, financial worries dominate daily life. In this situation, nearly every decision, whether it's related to healthcare, education, or simply enjoying time with family, revolves around financial constraints. Financial freedom means breaking free from this cycle, where your basic needs are covered, and you have room to focus on your personal growth, relationships, and happiness. It provides a sense of security that allows for peace of mind. The power of options. One of the most underrated aspects of financial freedom is the ability to choose options, whether it's choosing to switch careers, take a sabbatical, or start a passion project. Financial independence allows you to say no to things that don't serve your happiness or growth and say yes to opportunities that truly matter. This ability to make decisions based on personal values, rather than financial necessity, is one of the greatest forms of freedom. Freedom from debt. For many, true financial freedom begins with freedom from debt. High levels of debt can feel like chains, restricting future options and limiting the ability to take risks or make bold life changes. Becoming debt-free is one of the first steps toward achieving financial independence because it removes a significant financial burden and opens the door to opportunities for wealth accumulation and personal choice. Finding fulfillment, not just wealth. Achieving financial freedom also involves understanding that money alone does not bring fulfillment. Many people who reach financial independence realize that while it can provide comfort and security, happiness comes from how you use your financial freedom to live a meaningful life. This could mean spending more time with loved ones, traveling the world, volunteering, or pursuing hobbies that enrich your life. In other words, financial freedom is not an end goal, it's a tool to create the life you truly desire. Redefining success. Financial freedom encourages you to redefine success on your own terms. For some, success may be tied to material wealth and luxury, but for others, it could be about having enough money to focus on health, family, and personal passions. The essence of financial freedom is that it gives you the autonomy to define what success means for you, without being tethered to societal expectations or financial pressures. The FIRE movement, financial independence, retire early, and its psychological underpinnings. One of the most popular movements tied to the concept of financial freedom is FIRE, which stands for Financial Independence, Retire Early. The FIRE movement has gained widespread attention in recent years as people pursue aggressive savings and investment strategies with the goal of achieving financial independence far earlier than the traditional retirement age. But beyond just a financial strategy, the FIRE movement is deeply rooted in psychology and lifestyle choices. The psychology of FIRE. At its core, the FIRE movement is driven by a desire to escape the traditional 9-to-5 work cycle and reclaim control over one's time. Many people in the FIRE community are motivated by the idea that financial independence will allow them to live a more intentional life, free from the pressures of corporate work. The psychological appeal lies in the promise of freedom from the rat race, being able to pursue passions, hobbies, and experiences without the need for constant employment. Extreme savings and frugality. One of the defining characteristics of the FIRE movement is the emphasis on extreme savings and frugality. FIRE adherents often save 50% or more of their income, significantly cutting back on expenses in order to build up investment portfolios that will generate passive income. While this approach requires discipline and delayed gratification, it also appeals to people who value independence and minimalism. By living below their means, they prioritize long-term freedom over short-term pleasures, shifting their mindset from consumerism to intentionality. The power of passive income. A key element of the FIRE strategy is creating passive income streams, money that comes in without the need for active labor. This could be through investments in stocks, bonds, real estate, or other assets. The psychological appeal of passive income is the idea that your money is working for you, providing financial security without requiring you to trade your time for dollars. Once passive income covers living expenses, proponents of FIRE can retire from traditional work and focus on their true interests. Early retirement, a psychological shift. For many, retiring early represents a major shift in identity and lifestyle. While traditional retirement often occurs in one's 60s, the FIRE movement advocates for retiring in one's 30s, 40s, or 50s. Early retirement isn't about lounging around in leisure, rather, it's about the freedom to work on projects that are personally meaningful or take up new pursuits. This shift requires redefining what work and purpose mean in life. Many early retirees continue working in some capacity, whether through side projects, creative endeavors, or consulting, but they do so on their own terms. The criticisms of FIRE. despite its growing popularity, the FIRE movement has its critics. Some argue that extreme frugality can lead to a life of deprivation and that many FIRE enthusiasts may underestimate the challenges of not working for decades. There's also the psychological challenge of shifting from a mindset of constant saving and working to one of enjoying freedom and spending. For some, the adjustment to early retirement can bring unexpected feelings of loss or lack of purpose. Others may struggle with the fear of running out of money, especially if they retire very young and live for many decades without earned income. Moderating the FIRE approach. Many within the FIRE movement adopt a more moderate approach, sometimes called Fat FIRE or Barista FIRE. Fat FIRE allows for a more comfortable lifestyle, with a higher spending budget and more flexibility, while Barista FIRE refers to the idea of achieving partial financial independence but continuing to work part-time in a less stressful job. These variations acknowledge that financial independence doesn't have to be all or nothing. It can be customized to individual preferences and comfort levels. The psychological benefits of FIRE. For those who successfully achieve FIRE, the psychological benefits can be immense. Not having to worry about money, knowing that you have enough saved and invested to cover your needs, provides a tremendous sense of security and peace of mind. This freedom allows people to pursue lives filled with passion, creativity, and meaningful activities, rather than being tethered to work for the sake of financial survival. This chapter examines the deeper meaning of financial freedom and the psychological appeal of the FIRE movement. Chapter 7. Behavioral Finance Biases. Common money biases, recency bias, overconfidence, herd mentality, and more. Human beings are not always rational when it comes to financial decisions. Our emotions and cognitive biases often lead us to make choices that aren't in our best financial interest. Behavioral finance, a field that studies the psychological influences on investors and financial markets, highlights several common biases that shape how we handle money. Let's dive into some of the most prevalent ones. Recency bias. Recency bias is the tendency to give more weight to recent events than long-term trends or historical data. This bias can lead investors to make decisions based on short-term market movements, forgetting that markets are inherently volatile in the short run but tend to stabilize over the long term. Example: during a market rally, an investor might become overly optimistic and invest more heavily, believing the trend will continue indefinitely. Conversely, after a market downturn, the same investor might panic and sell off assets, fearing further losses, even though history shows that markets typically recover over time. Overconfidence bias. Overconfidence leads people to overestimate their financial knowledge, skills, or ability to predict market movements. This can result in excessive risk-taking or overtrading, as individuals believe they have an edge over others. Example: an investor who has had a few successful trades may start believing they can consistently beat the market, leading them to take larger risks without fully understanding the underlying factors that contributed to their earlier success. Herd mentality. Herd mentality refers to the inclination to follow the crowd, often disregarding one's own analysis or critical thinking. This bias is particularly common during market bubbles, where people invest in assets simply because others are doing the same, or during crashes, where they sell out of fear. Example: the dot-com bubble in the late 1990s is a classic example of herd mentality. Many people invested in tech stocks simply because everyone else was, driving prices to unsustainable levels. When the bubble burst, many lost significant amounts of money. Loss aversion. Loss aversion is the tendency to feel the pain of a financial loss more intensely than the joy of an equivalent gain. This bias often causes people to make overly conservative decisions or to hold on to losing investments too long, hoping they'll rebound. Example: an investor might hold on to a declining stock because selling it would mean realizing a loss, even though selling and reinvesting in a more promising asset could lead to better long-term returns. Confirmation bias. Confirmation bias is the tendency to seek out information that supports one's pre-existing beliefs or decisions while ignoring or downplaying information that contradicts them. This can lead to poor decision-making, as individuals only focus on data that aligns with their views. Example: an investor may focus only on news that supports their belief that a particular stock will go up while ignoring signs that the company is facing significant challenges. Anchoring bias. Anchoring occurs when individuals fixate on a specific reference point, often the first piece of information they receive, and use that as a benchmark for all subsequent decisions. This can lead to poor financial choices, especially when the initial reference point is irrelevant or outdated. Example: if someone buys a stock at $100, they might anchor to that price and be unwilling to sell it at $90, even if market conditions suggest the stock is now overvalued and likely to drop further. Mental accounting. Mental accounting is the tendency to separate money into different categories based on subjective criteria, rather than considering all money as part of a holistic financial picture. This can lead to irrational financial behaviors, such as treating a tax refund or a bonus differently from regular income. Example: someone might splurge their tax refund on luxury items while refusing to touch their regular income for the same purpose, even though the money comes from the same source, their overall wealth. How to overcome these biases. Practical strategies to make rational financial decisions. While behavioral biases are deeply ingrained, they can be managed with the right strategies. Recognizing these tendencies is the first step toward mitigating their effects on your financial decisions. Here are some practical ways to overcome common financial biases. Use data-driven decision-making. One of the best ways to counteract biases like recency bias and overconfidence is to rely on data and historical trends rather than emotional or impulsive reactions to short-term market movements. Before making investment decisions, review long-term performance data and consider how your actions fit within a broader strategy. Tip: develop an investment plan based on your long-term goals and risk tolerance, and stick to it, even during market volatility. Regularly revisit your plan to ensure it's still aligned with your goals, but avoid making drastic changes based on short-term events. Diversification to manage risk. To overcome herd mentality and loss aversion, diversification is key. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., you reduce the risk associated with any single investment. This helps temper emotional reactions, such as panic selling during downturns. Tip: regularly rebalance your portfolio to ensure it remains diversified and aligned with your risk tolerance. This will help you stay on track even when specific sectors or investments fluctuate. Set rules to counteract emotional decisions. Implementing rules-based strategies can help mitigate biases like anchoring and confirmation bias. For example, setting a predetermined threshold for selling a stock, such as a 10% decline from its peak, can prevent you from holding on to losing investments too long out of hope. Tip: use stop-loss orders or establish a rule that triggers a review of your investments once they hit a certain percentage gain or loss. These objective rules help remove emotion from decision-making. Practice mindfulness and delayed gratification. Recognizing the emotional impact of money decisions can help you stay calm and rational. Practicing mindfulness around financial choices, pausing before making significant decisions, can help reduce the impulsiveness associated with overconfidence, herd mentality, and loss aversion. Tip: before making any financial decision, especially one driven by emotion, ask yourself whether it aligns with your long-term goals. Take time to think through the pros and cons before acting. Automate financial decisions. To avoid mental accounting and impulsive spending, automate your financial decisions. Automatic transfers to savings or investment accounts ensure that your financial goals are prioritized over short-term desires. This strategy helps eliminate the temptation to spend money based on how it feels in the moment. Tip: set up automatic contributions to retirement accounts, emergency funds, or investment portfolios so you consistently save or invest without needing to make conscious decisions every time. Seek external perspectives. Overcoming biases like confirmation bias often requires outside input. Talking to a financial advisor, joining an investment group, or even discussing decisions with friends or family can provide alternative perspectives that challenge your pre-existing views. Tip: before making any major financial decision, actively seek out information or opinions that contradict your current beliefs. This can help you make a more balanced, rational decision. Focus on long-term goals. To combat recency bias and loss aversion, it's important to keep your long-term goals in mind. Investing is a marathon, not a sprint, and it's crucial to remain patient through both the highs and lows. Reminding yourself of your financial goals can help you stay the course during turbulent times. Tip: create a vision board or write down your financial goals and review them regularly. This will help you maintain focus on the big picture, rather than getting caught up in short-term market movements or emotional reactions. This chapter explores how cognitive biases affect financial decisions and provides practical strategies to overcome them. Chapter 8: Money and Relationships. How money affects relationships, the psychology of shared finances, financial compatibility, and conflict. Money plays a significant role in relationships, often shaping the dynamics between partners, family members, and even friends. It is one of the most common sources of tension in relationships, as differing values, spending habits, and financial priorities can lead to conflict. Understanding the psychology behind money in relationships is essential for fostering healthy, harmonious financial interactions. The role of financial compatibility. Financial compatibility refers to the alignment of values, attitudes, and habits around money between partners. When couples have similar financial priorities such as how they view debt, savings, or lifestyle expenses, it can reduce the potential for conflict. On the other hand, when financial views diverge, it can create tension that affects the overall health of the relationship. Example: one partner may prioritize saving for the future, while the other may prefer to enjoy the present and spend on experiences. If not discussed openly, these differing priorities can lead to arguments or resentment. Money as a reflection of values. Money is often seen as a reflection of personal values. How people choose to spend, save, or invest their money can reveal their deeper beliefs about security, success, and happiness. When partners have different values around money, it can lead to misunderstandings or unmet expectations. Example: for some, financial security might mean having a large emergency fund, while for others, it might mean owning a home. When partners don't understand each other's deeper motivations, it can lead to conflict, even when both are working toward the same goal. The psychology of financial control. Power dynamics can emerge when one partner has more control over the finances than the other. This is especially true in situations where one person earns significantly more or handles most of the financial decision-making. Financial control can lead to imbalances in the relationship, with one partner feeling disempowered or dependent. Example: if one partner controls the finances and makes all the spending decisions, the other might feel excluded or powerless, leading to feelings of resentment. This can strain the relationship and foster a sense of inequality. Money as a source of conflict. Financial disagreements are a major source of conflict in relationships. Whether it's about budgeting, spending on luxuries, or taking on debt, differing financial habits and goals can create friction. These conflicts often arise when money is used as a tool for control, when there's a lack of communication, or when partners have unspoken expectations about how money should be managed. Example: one partner may want to take out a loan to buy a new car, while the other may feel that saving for the purchase would be a better option. If not discussed openly, this disagreement can escalate into a larger conflict about financial priorities and trust. Debt and relationship stress. Debt, especially when it is not shared equally or openly communicated, can be a major stressor in relationships. Hidden debts or differing attitudes toward managing debt, such as whether to prioritize paying it off or investing, can create significant tension. The stress of debt can also lead to blame, shame, or guilt, further straining the relationship. Example: one partner may have accumulated student loans or credit card debt, which they keep hidden from their spouse. When the debt eventually comes to light, it can create feelings of betrayal, leading to mistrust and conflict. Building a healthy money relationship, communication and planning. While money can be a source of stress, it can also be a powerful tool for building a stronger, more connected relationship if approached with open communication and mutual understanding. Here are some practical strategies for fostering a healthy money relationship. Open and honest communication. Clear communication is the cornerstone of a healthy financial relationship. Couples need to have regular, open conversations about money, discussing everything from spending habits to long-term financial goals. This helps to ensure that both partners are on the same page and can prevent misunderstandings that could lead to conflict. Tip: schedule regular, money talks, where you review your finances together, set goals, and check in on your spending and savings. Make these discussions a judgment-free zone to encourage openness and collaboration. Create a joint financial plan. A joint financial plan helps to align both partners' goals and ensures that everyone is working toward the same objectives. This plan should cover short-term goals, like vacations or major purchases, as well as long-term goals, such as retirement or buying a home. By creating a shared roadmap, couples can avoid conflicting financial priorities. Tip: when creating a financial plan, consider each person's values and financial habits. Be sure to set clear expectations for how money will be saved, spent, and invested, and decide how to divide financial responsibilities, e.g., paying bills, managing investments. Separate versus joint accounts. One of the most common decisions couples face is whether to combine finances or keep separate accounts. There's no one-size-fits-all answer. The best choice depends on each couple's circumstances and preferences. Some couples prefer to pool all their resources, while others maintain separate accounts for personal expenses and a joint account for shared bills. Tip: discuss what system works best for your relationship. If you opt for separate accounts, be sure to set clear guidelines for how joint expenses will be handled. If you choose joint accounts, ensure that both partners have equal access and input into how the money is managed. Budgeting as a team. A budget is a powerful tool for avoiding financial conflict and ensuring that both partners feel empowered in financial decisions. By working together to create a budget, couples can set spending limits that align with their shared goals, preventing overspending or resentment over perceived financial imbalances. Tip: use budgeting apps or tools that allow both partners to track spending in real time. This ensures transparency and helps each person understand where the money is going. Consider setting aside fun money for each partner to spend as they wish, without needing approval from the other. Addressing financial imbalances. In many relationships, one partner may earn more than the other, which can lead to feelings of inequality. To maintain a healthy dynamic, it's important to recognize that financial contribution isn't the only form of contribution to the relationship. Emotional support, household management, and other non-financial contributions are equally valuable. Tip: if there's a significant income disparity, discuss how expenses will be divided in a way that feels fair to both partners. This might mean contributing a percentage of each partner's income rather than splitting costs 50-50. Dealing with debt together. If one or both partners are dealing with debt, it's important to approach it as a team. Openly discussing debt and creating a repayment plan together can help reduce the stress and prevent feelings of shame or blame. Tackling debt as a unit can strengthen the relationship, as it demonstrates mutual support and trust. Tip: when creating a debt repayment plan, prioritize high-interest debt first, but also make room in your budget for savings and investing. Working together toward financial goals, even in the face of debt, can foster a sense of accomplishment and unity. Financial counseling. Sometimes, financial disagreements or issues in a relationship require external help. Financial counseling or couples therapy focused on money matters can be beneficial in addressing underlying issues, improving communication, and finding common ground. Tip: if money conflicts are causing significant stress in your relationship, consider seeking the guidance of a financial advisor or therapist who specializes in couples and money. They can offer strategies for resolving disputes and creating a healthier financial relationship. This chapter explores the impact of money on relationships and offers strategies for building a strong financial foundation together. Chapter 9: Money and Mental Health. Financial stress and anxiety. How to manage mental health when dealing with money issues. Money can be a significant source of stress, impacting mental health in profound ways. Whether it's the pressure of living paycheck to paycheck, managing debt, or planning for the future, financial worries often lead to anxiety, depression, and other mental health challenges. Understanding how financial stress affects mental well-being is crucial, as is learning how to manage it effectively. The link between financial stress and mental health. Financial stress is deeply connected to mental health. Studies show that individuals facing financial difficulties are more likely to experience anxiety, depression, and other mental health disorders. This is especially true for people with overwhelming debt or those facing uncertain financial futures. Example: Someone struggling to pay off student loans while juggling rent and daily expenses may experience chronic stress. Over time, this constant pressure can lead to mental health issues like anxiety or burnout. Common causes of financial stress. Debt. High levels of debt, especially with high interest rates, can create a constant feeling of being overwhelmed. Job insecurity. Fear of losing income, particularly in uncertain economic times, can lead to persistent anxiety. Lack of savings. Living without a financial safety net can cause stress, as individuals feel unprepared for emergencies. Financial planning for the future. The pressure of planning for retirement, buying a home, or saving for children's education can feel daunting, especially for those with limited resources. The physical effects of financial anxiety. Financial stress doesn't just affect mental health, it can manifest physically as well. Stress-related health problems, such as headaches, insomnia, high blood pressure, and weakened immune function, are common among those experiencing financial anxiety. Example: someone who is constantly worried about money may have trouble sleeping, leading to exhaustion, irritability, and difficulty concentrating. This can create a vicious cycle, where lack of sleep exacerbates stress, further impacting mental and physical health. How financial stress affects relationships. Financial stress can strain relationships, leading to conflicts between partners, family members, or friends. Arguments about money, especially when finances are tight, can create tension and erode trust. This can further exacerbate stress, as relationship troubles add to the emotional burden. Example: a couple might argue frequently about how to budget for monthly expenses, with one partner feeling resentful if they perceive the other as irresponsible or controlling with money. Managing mental health during financial stress. While financial stress can feel overwhelming, there are strategies for managing both the psychological and practical aspects of money issues. Here are some effective approaches to maintain mental well-being while navigating financial challenges. Seek professional help. Financial stress can often be alleviated by seeking advice from professionals, such as financial advisors or credit counselors. These experts can help create a budget, develop a debt repayment plan, and provide guidance on saving and investing, reducing the burden of financial uncertainty. Tip: if the stress becomes unmanageable, consider seeking therapy from a mental health professional. Cognitive behavioral therapy, CBT, is especially effective for helping individuals manage anxiety and reframe negative thoughts around money. Develop a financial plan. One of the best ways to reduce financial anxiety is to have a clear plan. Creating a budget and setting financial goals can provide a sense of control and purpose. Knowing where your money is going, how much you're saving, and how you're paying off debt can reduce feelings of uncertainty. Tip: use budgeting apps or tools to track your expenses and create a realistic financial plan. Prioritize essentials, such as housing and food, before addressing non-essential spending. Build an emergency fund. An emergency fund acts as a financial safety net, providing peace of mind during unexpected expenses. Even if you can only contribute small amounts at first, building a fund gradually can help alleviate the stress of living paycheck to paycheck. Tip: aim to save 3 to 6 months' worth of living expenses in an emergency fund. Start by setting aside a small percentage of your income each month, and gradually increase your contributions as you're able. Practice mindfulness and stress reduction techniques. Incorporating mindfulness practices, such as meditation, deep breathing, or yoga, can help reduce the emotional burden of financial stress. Mindfulness helps individuals stay present and avoid ruminating over financial problems, making it easier to approach money issues with a clear, focused mind. Tip: spend a few minutes each day practicing mindfulness techniques, especially during times of financial worry. Mindfulness can help break the cycle of stress by promoting relaxation and emotional clarity. Focus on what you can control. Financial stress often stems from uncertainty about the future. While you may not be able to control every aspect of your financial situation, focusing on what you can control, such as your spending habits, saving strategies, and debt repayment, can help reduce anxiety. Tip: break down your financial goals into small, actionable steps. For example, instead of focusing on the total amount of debt you owe, focus on paying off one loan or credit card at a time. Limit exposure to financial triggers. constantly checking your bank account, obsessing over investments, or comparing your financial situation to others can heighten stress. While it's important to stay informed, overexposure to financial news or frequent comparisons can lead to unnecessary anxiety. Tip: set boundaries for yourself when it comes to checking financial information. For example, limit how often you check your investments or avoid reading sensationalized news about market crashes. Wealth and well-being: how financial wellness can lead to better mental health. On the flip side, financial well-being can have a profound impact on mental health. While money itself doesn't guarantee happiness, financial stability and a healthy relationship with money can reduce stress and improve overall well-being. The psychological benefits of financial stability: financial stability provides a sense of security, which is essential for mental well-being. Knowing that your basic needs are met, that you have an emergency fund, and that you're saving for the future can lead to reduced anxiety and a greater sense of control over your life. Example: a person with a solid financial plan, emergency savings, and no overwhelming debt is less likely to experience the chronic stress associated with financial uncertainty. Financial freedom and life satisfaction: financial freedom, the ability to live without worrying about money, can significantly improve quality of life. This doesn't necessarily mean being wealthy, but rather having enough resources to meet your needs and pursue your goals without constant financial worry. Example: someone who has achieved financial independence through smart budgeting and saving may feel more fulfilled, as they can focus on personal passions, relationships, and experiences rather than financial survival. The power of financial literacy: financial literacy, the knowledge and skills needed to manage personal finances effectively, can also enhance mental well-being. When people understand how to budget, save, invest, and manage debt, they feel more confident in their financial decisions, reducing anxiety and stress. Tip: invest time in learning about personal finance. Books, online courses, and financial advisors can help you build the knowledge you need to make informed decisions and take control of your financial future. The role of financial gratitude: practicing gratitude for what you have financially, rather than constantly striving for more, can also improve mental health. While it's important to have financial goals, focusing on what you already have, whether it's a steady income, a roof over your head, or savings in the bank, can foster contentment and reduce the pressure to always seek more. Tip: incorporate financial gratitude into your daily life by acknowledging the positive aspects of your financial situation. Even during tough times, focusing on what you have can help shift your mindset from scarcity to abundance. The intersection of wealth and purpose: finally, aligning your financial goals with your life's purpose can bring deeper satisfaction. People who use their money in ways that align with their values, whether it's through charitable giving, investing in experiences, or pursuing meaningful work, often report higher levels of happiness and fulfillment. Example: someone who values helping others may find great satisfaction in donating to causes they care about or using their financial resources to support their community. This chapter addresses the complex relationship between money and mental health, offering strategies to manage financial stress and emphasizing how financial well-being can enhance mental wellness. Conclusion: mastering the psychology of money. Key takeaways. Recap of important lessons. Understanding the emotional side of money: emotions like fear, greed, and anxiety deeply influence our financial decisions. By recognizing and managing these emotions, we can make more rational, effective choices with our money. Mindset shapes wealth. The difference between a scarcity mindset and an abundance mindset significantly impacts financial outcomes. Cultivating a mindset of abundance can open doors to wealth-building opportunities and lead to better financial habits. The role of history and human nature in money: our financial behaviors are influenced by evolutionary instincts and societal history. From bartering systems to modern digital currencies, understanding the evolution of money helps us navigate financial systems more wisely. Money, status, and happiness. Wealth does not equate to happiness. The pursuit of material wealth often leads to status anxiety, while true contentment stems from aligning money with personal values, purpose, and meaningful experiences. Risk and reward in financial decisions. Risk perception and loss aversion shape how we handle investments and financial opportunities. To build wealth, it's essential to assess risks rationally and understand that calculated risks are part of long-term financial success. The power of time and patience in wealth building. Compounding is a powerful tool in growing wealth over time. Shifting from short-term gratification to long-term planning requires patience but yields significant financial rewards. Financial independence and freedom. True financial freedom is about more than just having money, it's about the ability to make choices without being constrained by financial pressure. The FIRE, Financial Independence, Retire Early movement highlights the psychological benefits of this freedom. Overcoming behavioral finance biases. Cognitive biases, like overconfidence and herd mentality, often lead us to make irrational financial choices. Recognizing and countering these biases helps us make smarter, more objective financial decisions. Money's impact on relationships. Money plays a crucial role in relationships, affecting everything from communication to conflict resolution. Building a healthy relationship with shared finances requires openness, planning, and mutual respect. Money and mental health. Financial stress can take a toll on mental health, leading to anxiety, depression, and other issues. Managing financial stress through mindfulness, planning, and professional help can improve overall well-being. Final thoughts. How mastering the psychology of money leads to a fulfilling and financially stable life. Mastering the psychology of money goes beyond merely understanding financial tools. It's about transforming your mindset, behaviors, and relationship with money. When we comprehend how emotions, biases, and societal pressures shape our financial decisions, we can begin to make choices that align with our goals and values. Financial freedom is not just about accumulating wealth, it's about using money as a tool to build the life you want. Whether it's securing your future, providing for loved ones, or pursuing your passions, a healthy relationship with money enables you to live with purpose and satisfaction. By applying the lessons from this book, you'll not only develop better financial habits but also gain the psychological resilience to navigate challenges with confidence. In doing so, you'll find that mastering the psychology of money is key to achieving not just financial stability, but also a life of fulfillment, security, and meaning.